As we step into 2023, the stability of the global housing market is under increased scrutiny. The echoes of previous market crashes still haunt our collective memory, leaving investors, homeowners, and policymakers anxious about the possibility of history repeating itself. It is unsurprising that most people believe we are in a bubble. But the thing with bubbles is that you do not know until it's too late, and it collapses on everyone. This assertion is true and can be seen throughout history. Already, there are people raising the housing issue alarm, but the common belief is that we are not in a bubble. Rather, we are at the peak of the housing price range, and it threatens to become the norm. Although these high house valuations are now seen as the new normal, and even though we have seen this happen in the past, the question becomes, are we in a bubble? And if we are, when will the collapse come? This question is one that has left everyone in a quagmire, considering the crazy developments we are seeing in the housing market. Over the past 10 years, the U.S. housing market has seen meteoric price increases. As we discussed in the previous video, according to the S&P Case-Shiller Home Price Index, from 2013 to 2023, home prices in major metropolitan areas have soared by an average of 50%. This situation is not limited to the United States. We see this astronomical increase all across Europe and even in some African countries. Since 2009, real estate prices have doubled in England, and even in South Africa, the pattern is seen. This increase in prices is almost consistent, and it is likely not a coincidence. After the 2008 recession, a lot of policies were put into place to mitigate the effects. Every market will always cave under a unified government policy, and this impact we are seeing seems to be the result of a policy following the Great Recession. Lots of governments, in a bid to combat the effects of the 2008 recession, lowered mortgage interest rates to nearly zero for the past 10 years. However, these good intentions seem to have exploded back in their faces naturally as rich people seeking to make more money took advantage of the policy, as real estate is one of the businesses with great returns. Before we get into that, please take a moment to like this video and click on the subscribe button. It helps YouTube's algorithm push our videos out to the public and encourages us to make more videos concerning the economy. Due to the low rates over the last 10 years, mortgage rates remain below 5%, and at some point even 4%. While this is great for the masses of regular, hardworking people who had the opportunity to buy homes using those low rates, the low rates also attracted the rich class of investors, like bees to nectar. And they leveraged the opportunity to sink in an unbelievable amount of money to purchase houses at a record low rate. These houses became second homes, investor homes, vacation homes, and Airbnbs. Records show that almost 40% of the houses in America are owned by people who do not live in them, and this reduction in primary owners coincides with the interest rate changes of the last 10 years. In simpler terms, the increased rate of purchasing homes at low rates by rich investors has ruined the market value for us, and now it seems like the market will crash, leaving many of us running around like headless chickens worried, and it is all because of ambitious investors. The staggering growth of Airbnb, second homes, and other real estate purchases has fueled concerns of a housing bubble. And we are not the only ones complaining. All over social media and among the general population, there are lots of concerns about the future of housing. Some can argue successfully that we are currently in the most unaffordable housing market since 1993, even though there have been times and periods when conditions were as bad as today. Many people will argue that today is worse and that nothing compares to the challenges homebuyers are currently facing. Well, that may be right because the bubble has swollen to a staggering size that has never been seen in history. While some may point to the 1983 dip as proof that things may not be as bad today as they once were, they fail to note the difference in circumstances. Yes, in 1983, the mortgage interest rate was as high as 18%, but the high interest rate did not last, and after a month, it fell back to 16%, then 12.3%. This decline allowed homeowners who bought homes at the high rate of 18% to refinance. These rates may also feel outrageous, but they were only slightly above normal up until the late 1990s. It was the early 1990s that interest rates went below 10%. As a matter of fact, A good look at the year-over-year analysis shows that what went down in the housing market over the last 2 years hasn't been seen in years. The increase is almost 2 times worse than what we had in the 1980s. Yet, we cannot really say what this means for the market, because it is a new phenomenon. But there are many speculations. Alright, many people speculate and expect that a big crash is imminent, and we will finally see that bubble pop. They assume that this crash will come under the cloak of investor capitulation, which is essentially investors panicking. Right now in America, the short-term rental market is extremely common. These are houses owned by investors with the sole purpose of turning a profit. They rent them out to vacationers in tourist cities like Las Vegas, Miami, and others. One of the reasons for the crash by investor capitulation is the fact that most of these homes were bought using the DSCR loans. DSCR loans are loans that are not based on personal income, but rather on future cash flow. So you see, it does not exactly show stability. In other words, instead of a bank's lending decision being solely based on your financial stability, the decision is based on estimated future revenue. Originally, DSCR loans were meant for commercial properties that have recently been extended to Airbnb. In fact, it is the driving force of the Airbnb market. While this loan is great for new and upcoming investors, the problem is that it relies on assumptions of future cash flow and often overstates the incoming revenue badly. This overstatement, in turn, affects the housing market, driving home prices up as investors struggle to make their loan payments. People who speculate that a crash is coming soon say that the market will struggle due to the oversaturated Airbnb market. Simple economic equation. As the demand is falling, the theory is that many of these DSCR loans will go bad. These default loans will trigger an avalanche that will cause a huge crash in the market. The housing market's fate hangs in the balance of interest rates, which have been at historic lows for years. However, as the economy recovers from the shocks of the pandemic, the Federal Reserve has signaled its intent to raise interest rates. For every percentage increase in mortgage rates, the monthly payments on a median-priced home can increase by hundreds of dollars. This could just push many households to the brink and discourage investors from the market. So the primary thing to keep in mind about housing is that it works on the Pareto principle, which is essentially 80% of the changes come from 20% of the causes. In real estate, it means that prices in a specific place can be driven down or reset by a few sales. The idea is that a small percentage of sales can reset the value of larger populations of homes in the market. So, if we follow this principle and assume that one investor puts up 50 houses for sale at $500,000, it will shift the valuation of around 1,000 homes close by. It's always hard to determine when it's a good time to sell, and an act of capitulation can lead to significant price decreases. Keep in mind that this is a game of crisis. In a game of crisis, it's not losing money by selling too early. After all, home prices go down more when a rush sale starts, and it's hard to put out that fire. It is about waiting for the market to normalize and see real estate as a long-term investment. After all, the original intent of the real estate market was to be a long-term investment. The arrival of Airbnb, while a great short-term investment, seems to be doing more harm than good to the bubble. If there is ever a fire sale with these Airbnb properties and investors panic, selling may just be the straw that breaks the camel's back, and what would collapse the market in a way we have never seen. Thank you guys for watching this video, and as always, make sure you click on that like and subscribe button. Turn on your notification button to get an alert each time a new video drops. There is a lot we will be discussing concerning global economics. Also, leave a comment below letting me know your opinion on the housing market situation around you.